I'm Ernie Humphrey, Educational Programs Leader for Performative, the largest online community for corporate finance, accounting, treasury, and related professionals. I'd like to welcome everyone to today's webinar, Equity Compensation, the 4 pillars of effective reporting and 3 key accounting pitfalls. Equity compensation is an essential tool for attracting and retaining top talent, managing working capital, and motivating employees to think like shareholders. Designing and administering effective share-based compensation programs is a huge job, and compliance with dynamic accounting and reporting requirements can be a burden. Today our speakers will share with us the 4 fundamentals of effective equity compensation reporting and offer us actionable advice regarding how to build the right infrastructure, processes, and best practices for reporting for your company's share-based compensation plan. I would like to thank Equity Administration Solutions, EASY, whose commitment to thought leadership helps us make this webinar possible and delivered at no cost. A quick note on today's agenda. First, we'll experience a joint presentation for our featured speakers. Then we'll move to the interactive Q&A session where we will spend the remainder of our hour. We would like this to be an interactive experience for you. So if you have any questions at any time, please go to the questions area and you go to our control panel and send us your questions. We can't promise to get all them in, but we will do our best, and we'll follow up afterwards on any questions we do not get to today. A few logistical notes about the webinar today. Links to today's presentation and video recording will be sent out to all attendees within 24 hours of the event. Those who would like CPE credits will need to answer all polling questions during the event and should have pre-registered for CPE credit. For any questions on CPE credits, please send an email to cpe@performative.com. Those attendees who qualify for CPE credit will be sent a CPE certificate via email within 24 to 48 hours of the event. Again, we encourage you to ask questions on today's topic at any time during the questions box in your GoToWebinar control panel at any time during the webinar. Finally, immediately following the webinar, we ask to take a short survey. We greatly appreciate your feedback regarding our event today, as we always strive to improve the ROI we offer our event attendees for their valuable time. A quick word about Performative. Performative is the largest online community and resource for senior-level corporate finance, accounting, treasury, and related leaders. Performative connects corporate finance leaders to provide instant advice and insights on the tough financial and strategic challenges that they face every day. It's now my pleasure to introduce today's speaker, Carolyn Price. Carolyn is Vice President of Corporate Accounting at Penn National Gaming and has worked at Penn National since 2001. Her responsibilities at Penn National include consolidations, financial accounting and reporting, application systems design and implementations, and payroll and stock option administration and accounting. Prior to joining Penn National, Carolyn was a controller for Delaware Transit Authority, DTA. At DTA, she was responsible for financial reporting and regulatory reporting and compliance to the Federal Transit Administration. Prior to work at DPA, Carolyn spent several years as an auditor in public accounting. She earned a master's in business from Wilmington College in 1996 and a bachelor's degree in accounting from Goodley Beacom College in 1990. Our other featured speaker today is Kathy Biddle, Financial Reporting Specialist, Equity Administration Solutions. Kathy is a certified equity professional and is a financial reporting specialist with Equity Administration Solutions. She has more than 20 years in the equity compensation business and is specialized in equity plan administration and financial reporting. Prior to her position at EASY, she was a financial reporting specialist at AST Equity Plan Solutions, a relationship manager at AST and First Union National Bank, and an executive compensation manager at Core States Financial Group. With that, it is my distinct pleasure to hand the floor over to Kathy Biddle. Kathy, the floor is now yours. Please take it away. Thank you very much.
Good afternoon. We're going to cover a couple of things today. As you mentioned, we're going to go over the 4 key things. And the first, of course, is why equity comp? Well, we want to help companies align interests between the company's strategy for success and the employees. We want to attract and retain top talent. And as an additional component to that is for retaining and top talent is making this part of their compensation. We want to manage working capital for the organization and help employees share in the long-term success and value of the company. Reporting burden, of course, is the regulatory requirements. Over time, these have increased consistently. We have more and more accounting rules that impact how we do reporting. And a lot of the decisions and the assessments that need to be made are subjective. And of course, the ultimate is the short time frames. We get more regulatory and more reporting burdens, but we have no more additional time in order to complete all that. So 4 best practices that we recognize for this area is make the accounting treatment a part of your plan design. It's not always an easy thing to do, but it is an important part as you look at plans to try and determine, the best design. Carolyn, from here, I'll let you talk some more about the rest of this part of this.
Okay. Basically, these 4 best practices that we're going to talk about can dramatically ease the financial reporting burden and complexity associated with equity compensation plans. And if you use these to create the right infrastructure and processes and procedures, it will help your company while preserving the advantages of equity compensation. The drivers of complexity in designing your plan. The first, types of equity awards. Restricted stock or units or stock options or even cash-settled appreciation rights. I caution everybody to be aware of cash-settled items and the complexity of liability accounting. I myself was faced with a situation where one day I was told we decided to grant CSARs and you need to carry forward with this. And our system at the time had no functionality for liability accounting, and it is extremely complex. First doing it in Excel, and then I had to look for a system that was going to support it because it was so complicated. It was something that we could not keep doing in Excel. And also be aware that not all systems who do support liability accounting do it in a very straightforward and easy manner. There are some products out there that do offer it, but it is extremely complicated on how you have to revalue those liability awards every time you want to revalue those. Other items to think about as you design your plan are vesting types, whether you want to do just straight vesting over a 4-year period, performance, and then you get into the performance metrics of do you want to pick targets based on EBITDA or something like that, revenue, and how long those performance periods are going to be, if they're going to be annual or multi-year. And then you get into what are the goals that you're going to set for those awards. Are they relative, where you're going to, value your company against your peers? Are they going to be absolute and you're going to value them within yourself as far as % of your revenue growth or your earnings per share?
We have a couple of examples here for classifications for performance. As we mentioned, when you start to look at performance plans, you want to keep in mind, first of all, what your goal is that you want to achieve by using performance equity, whether it be in the form of options or in the form of a restricted-based or even a cash-based award. Some of the examples here for performance conditions would be EPS, revenue targets, market share, change in control. Some examples of market conditions: relative TSR, stock price, absolute, market stock units, internal rate of return. And keeping in mind that market conditions, regardless of how you pay at the end, so when you come to the final vest or the release, market-based awards, you will have to take the expense whether you wind up with less or more shares issued. So with performance, your expense will be based on the percentage ultimately at the end of the performance period. You may also, in some cases, want to use multiple performance measures and multiple targets or multiple performance measurement periods. We've worked with clients who had 2 or 3 different metrics, and each of those metrics had more than one measurement period. So as you're looking in design and plan design and performance goals, keep in mind you need to be able to manage all these different measures. So you want to be very clear exactly what you are looking to do, and then look at the accounting ramifications for doing that. And remember, the more complex the plan, the harder it is to explain to participants, the harder it is to administer.
Okay.
Alan, you want to talk a little about this one?
Yep. Okay, involve accountants in design phase. This is huge. I have felt this pain myself. Typically, many comp plans for executives are designed by board-level compensation committee, and that often involves decisions and communications among people who may not be well-versed in the accounting principles and the application of those principles. This can give rise to very unpleasant surprises at year-end when the true impact of the grant is felt is unintended, sometimes in shocking ways to your bottom line, and you find yourself where it loses the entire intent of the program because it wasn't what you intended it to be, because they didn't understand what the accounting was going to do. Create and run scenarios. It's good to have a system where you can test various scenarios and how various equity types may impact your company financially, and allow you to forecast on how they may impact your financial results. These scenarios and testing those can also help your HR and your comp committee understand the value of exactly what you are awarding your employee, because you must understand all the, the value that comes back to the employee. In interpretations before implementation, different accountants and auditors will often have different opinions about how a plan should be accounted for. So don't forget to get your accounting firm involved early on. If you're doing something new for the year, involve them during your testing phase so you can all agree that your system and how you have it set up is doing what everybody expects. Determine financial and tax accounting implications, not just compensation costs. This is very true because equity does have a huge impact on your tax department. Tax should also be involved early on, not just for the taxability, but from a system design standpoint on how they are going to track their deferred tax assets and relieving those assets for those awards.
So now we'll go on and we'll talk some more now on quarter-end challenges. So we've got even more information than ever in shorter time frame since FAS 123R came out. It continues to get more information. There's always the race to file your 10Q. You have to have processes for this, for quarter end, that are structured, that are defensible, efficient, and repeatable. And I can't say enough, automation is the key, no matter how you do it, whether you do it from a spreadsheet that you have built-in ways to get the information quickly, or whether you're using a system that does it. Automation, the more you can automate, is critical in a short time frame that you have. So as part of that automation, there are some things to consider. You can have, there's different ways to handle it. Some in automation outsource the calculations. So once you get to a quarter end, you have a third party do all of your quarter end reporting and work for you. And so advantages to that, they address your specialized business needs. Innovation can result in competitive advantages, but then there are also can be disadvantages, like significantly higher initial costs. Necessitates working with development team and ongoing maintenance when you do a custom software solution. Software that you have installed on site, there's usually a lower initial cost, but the vendor risk is limited to the functionality, and hosting is on your own environment. Disadvantages, you can find they're difficult to predict future costs. Transitions to new versions can burden stock administration teams and IT teams in order to accomplish those. And a fourth choice is using SaaS, software as a service. So your advantage is you have less demand from your IT. They're more accessible typically for mobile or remote administrative teams. The scaling to future growth is easier. Some disadvantages, you have less control over the software version. It increases your vendor risk assessment requirements, and it may increase data privacy requirements, all of which you can get, have to look at in making a decision on the best way to automate. One of the things that we've always suggested is that having a monthly activity checklist can be beneficial to you. As we said, you have a very short time frame and a lot of information to gather. So what we suggest is you might want to build yourself a checklist that says, I've checked with these and made sure with those where we could, with those departments like HR, if that is who does your grants, you want to make sure you have all the latest grants from them. Has anything pending with legal that might impact your quarter end? All these things that come together. Then audit your data monthly. Bad data equals incorrect calculations. Sometimes it is worthwhile running reports a few days before quarter end to look for any glaring anomalies or anything that would jump out so that you're not in that 3 or 4 day period at the end of the month or the quarter where you've got to close and suddenly something doesn't look right. It sounds like it takes more time, but it's easier to do 3 or 4 days before quarter end than it is to do it in that short time frame. And then you also want to regularly review your policies and methodologies. And as an ongoing process, do they still make sense for the company? Do we need to make changes? What organizational changes have happened that might impact our policies and our methods for gathering all this information? And then another is when you, no matter whether you're using an in-house system or an external or a software package, make sure you understand the calculations and the methodology in the accounting reports. And because you own the process internally. So when the auditors walk in the door and ask you for information, you have either know where you can get it quickly or you have it already documented or something that you can say to them, here's the information. Because if you are relying on getting that from an unknown source in a short time frame for the auditors, you don't want it to look like you don't know what that is doing, that you're booking and you're processing without knowing the impact it will have on your bottom line. And seek out and stay abreast of regulations to ensure you're calculating the correct numbers. There are so many sources today. 20 years ago when I started, it was not that easy to get all that information from one place. So there are so many sources, so many ways to stay on top of it. So take advantage of anything that you can get that will help you know as things are changing so you can be prepared. You can check to see, is this built into our software? Has our vendor already know that this is coming and can address it? So these are all things that will make your quarter end and your processing go much smoother.
Yeah.
So, Carolyn, if you want to talk a little about structured controls.
Yep. Equity impacts numerous departments within your organization, and it is essential that your company have well-defined set of documented controls and documentation of those processes. IT and technology. Think about how you're going to capture the data and how that data is going to move across systems. When you talk about equity, you're going to need information from payroll, you're going to need your equity information, and you're going to need information going to your general ledger. So you have data moving across multiple systems, and you need to think about how you control that. Grants. If your comp committee comes up with something new, always make sure that it meets your plan requirements and go back to the legal documentation. And there's some great systems out there now that allow you to automate grant acceptance, to allow you to verify that your employees are properly notified, to take the paperwork part of it out of the equation and kind of simplify things. Vesting and exercise. If you have a third-party administrator or a broker that executes your exercises, vestings, your controls must be in place to make sure that their system stays in sync with what you have with your internal system. If you decide to use a broker, their system may provide you various options when you exercise, such as do you allow an employee to increase their federal withholding. You must decide on those type things when you go through a conversion and decide and document those types of processes and how you want to handle those. There's so much flexibility out there now in systems, so you have lots of choices to make. So you just need to make the choices and then make sure you document them well. With broker interfaces and payroll interfaces, there's always a lot of data going back and forth. So just to reiterate, the controls are crucial to make sure that that data going back and forth, it preserves the integrity of the data. Okay, tax and payroll. Payroll coordination with tax to ensure that proper taxes are withheld from employee exercise investing depending on your different equity types. So if you have ISOs, you need to make sure that your payroll department knows that you don't withhold your Medicare tax, and that would be a good example. Should you choose to use a broker to administer your plan, these items can be automated, and then you can have your payroll department verify and approve before transactions are settled. Tax, always remember, tax will always need data from your exercise investings for their tax accrual to relieve their deferred tax asset. An equity system is a great system to be able to provide that type of information to your tax department. Accounting. To ensure the accuracy of your accounting reports, controls must be in place for grants and terminations, exercises, and the timely entry of these events for proper month-end reporting. I personally like to prove everything out on a monthly basis. I don't wait for the end of a quarter. We have too much going on, and it gets too complicated to reconcile everything at quarter end. So you want to make sure that those reports roll properly from month to month. Because if you don't, and I've had this happen where somebody backdates a termination and they terminate in the prior month, and then you have a reconciling item. So the timely entry of these events is very important to keep your system correct. Legal, think about how you're going to put controls in place so that exercises do not occur during blackout periods. If you decide to use a broker or a plan administrator, then they can block that out for you. But you have to think about how you can do that and put that control in place.
And now we talk about the three biggest gotchas, as we call them. One is rounding for share withholding. The second is true-ups and forfeitures, and the third is modification. Probably no surprise. Rounding for share withholding and excess withholding. So a conservative reading of ASCII 718 argues that liability accounting is required if share withholding is rounded up, and that over-withholding is no longer immaterial. But administratively, rounding up is far easier and avoids touching an individual's paycheck. So many auditors are starting to support the spirit of the accounting standard. Now, most observers agree that a 1% overage is tolerable. If you reach 3 to 5%, you may need to adjust your methodology, and you need to make and stick with your decision in consultation with your audit partners. And I would suggest, if your plan allows for rounding up, that you talk to your auditors on a regular basis to make sure that opinions have not changed and that they're still consistent, and give them some examples so they can see what that percentage of variance is, so that you don't find yourself suddenly being told by your auditors that this is now liability accounting, and that you don't want. You don't want it to have to come back and become a change, or have to go back and restate or recalculate anything for that. The next is true-up at vesting versus true-up at termination. So when should you true-up your share accounting? Well, at vesting time, or static, or at termination, which is dynamic. So when you true-up at vesting, your forfeiture rate stays the same over the service period, and the forfeited grants remain on the accrual reports until after the final vesting date. So that complies with ASC 718, and it's easy to manage it. If you true up at termination, the forfeiture rate changes during the service period. So it can be a more realistic method, as smaller, more frequent true-ups create consistency over time. Although this method emerged after the publication of ASC 718, it's generally accepted by most practitioners. And if you're looking at systems that support it, you need to ask the questions about how they true up at vesting versus termination. Some will, as it mentioned, you could have someone who terminates, but the expense will continue to book until the very last vesting date, and then reverse. Others will true up along the period where it trues up at vesting and it trues up at termination, and so that they then effectively if someone terminates, the final adjustment is made at termination and they come off your expense report. Others will carry it, as I said, carry it all the way through. Some systems you put your forfeiture rate in and it applies for the life of the grant. Others allow you to make adjustments. And the last is the hyperbolic. So you can do calculations for your forfeiture rates, which are required that you estimate forfeiture rates. You want to look at the different methodologies used. Some will use just a flat rate. Some will compound it over the life of the grant. Others will, there's also the dynamic where, in theory, I have a 10% rate today, but the longer the person stays, the more likely they are to stay till the very end. So it automatically adjusts itself every day. So there are ways to look at how you true up and how you calculate and how you estimate. And you want to be very aware of how you're doing it and how you can explain it and show examples to your auditors so there are no questions about how it's being done. We find that a lot of auditing firms are becoming more and more comfortable with the dynamic forfeiture calculation that self-adjusts over time. Disadvantage is that it's harder to see changes. When you use a static process over time, your expense amount that you're accruing in anticipation of the true-up is consistent. With a dynamic, it changes every day, every month, so it's harder to predict, yet it is more realistic. The third one that we talked about was material modifications. So Carolyn, you want to talk some about this?
Yep, I can. There are some modifications that trigger modification accounting, such as option exchanges like a repricing or an exchange. There is equity restructuring. Some spin-off or stock split transactions will require a modification. Acquisitions. Some other changes, such as an extension of the original grant term period. Something to keep in mind here is that some equity systems do not support modification accounting. They may have a workaround, such as a cancel and regrant, but should you decide to do a modification, you should make sure that you have a plan in place to implement it. I myself found myself in a situation where we decided to extend the life of our grants back when the stock market crashed, and our system at the time did not support modification accounting. So we had to cancel our grants and then re-grant them as a workaround, and it was quite painful, and it still continues to cause us problems with those grants. So it definitely is good to have a system that allows you to do modification accounting. You should also make sure that when you do modifications, if you have an equity system that feeds into a broker system, that not all interfaces between your equity system and your broker system will bring all data over. Sometimes it's just a few fields and not all fields. So sometimes if you modify something like the expiration date in your equity system, you need to also contact your broker and have them updated on their side as well. So that's just something to keep in mind. There are also things that do not trigger modification accounting. There are some spin-offs that don't require modification. We personally had one here at Penn. We determined that the fair value before our spin-off and after our spin-off was exactly the same, but we still had to do a lot of system finagling, or whatever you want to call it. Kathy and I spent many, many weeks and hours because we had to split our fair value and our strike price and our deferred tax assets. So even though we weren't doing a modification, we still had to modify the data and pull it into two pieces. So without a system, we never could have gotten through that transaction. Another thing that doesn't trigger modification accounting is acceleration of vesting. But you still have to change your system so that you don't get any additional expense, but the calculation must be done to get that expense accelerated in the proper accounting period. And that is something when you decide to get any type of equity system to make sure that it supports that functionality, because that's pretty important. Additional features such as permissible exercise methods. With this, sometimes you may do a modification that changes an ISO may convert to a non-qual during a modification, so that's something to keep an eye out whether your system will allow you to make that conversion. I think here the key is that modifications do come up quite frequently with equity accounting, so it's good when you go to look for a system that you find one that supports it.
Okay, thank you very much for that great content. I'll go ahead and open up our Q&A session. Again, anyone who has any questions, please go to the questions area and you go to Webinar Control Panel and ask us your questions. The first question I will direct to Kathy. Can you give us a sense of what you're seeing in the market is in terms of performance awards, single metric versus multi-metric, what you're seeing right now?
Well, right now we're still seeing mostly single metric. We have a few that are seeing more, but we're seeing more and more companies looking to use performance. So, but the most common right now is still a set period of time with one single metric over a single period and determine at the end the multiplier what that will apply to the whole grant. And some, we're still, I would say it's still about half and half, where at the end of the performance period, the payout could be up to 100% of target, where the other half go even higher than target, somewhere anywhere up to 200%. So, but we are seeing more and more performance.
Okay, great. Thank you very much. I'll go ahead and direct my next question to Carolyn, and Kathy, please jump in if you like as well. There's a question around someone is mentioning that they thought we're talking about Medicare withholdings and that you don't have to withhold for ISOs, and they're asking what about NQSOs? Yes,
you do have to withhold Social Security for non-qualified stock options.
Right. Including the new additional Medicare, yes.
Yes, yes.
Right.
Okay, great. Next question I'll direct to Kathy. So someone is making the comment regarding the poll around why Excel is so prevalent, is that most of the systems don't really account for the liability award instruments. Can you give us a sense of, solutions out there? Are they getting better on that front, especially on the SaaS side, or is that a focus that you know of for improvements on that side?
Well, I work for a SaaS company, so our product, we look all the time at making improvements to all of it. But as far as liability accounting, I can't speak to a lot of other systems because I don't have enough experience to be able to answer how they handle it. We do handle it well, and I think Carolyn can tell you that because she has liability accounting awards within our system. So I'm not sure what your concerns are. Are your concerns specific to some portion of the liability accounting that you're not seeing?
I mean, I can jump in a little bit on this.
Good. Yeah.
I can tell you that before we had Easy, we had Equity Edge, and Equity Edge does not handle liability accounting. And we kept asking them, when are you going to put this functionality in? We need this functionality. And they said that they didn't have the customers asking for it, that we were one of the few, which I found hard to believe. So that is when we decided to look for a new system, because I was keeping track of my regular equity in Equity Edge, and then I was keeping track of my liability in Excel, and it was crazy. So we looked I looked at a lot of systems, and Easy by far has the best liability accounting system that I saw. There are some systems out there that offer and say they support liability accounting, but you have to do things like you have to, every time you want to market those liability awards, you have to actually export data from their system, manipulate it, and then re-upload it back, which I thought was no better than being in Excel. And one of the reasons that I decided to go with Easy is because Easy revalues your liability instruments every day, because it uploads your stock price on a daily basis automatically, and so every day it gets marked to market, and it prints out a report and tells you, you know, where you should stand with that award. And it's been great for us, especially because our stock price is very volatile and it can go up and down, and we have big swings back and forth, so we have to market it every month to stay on top of it. So you know, so there are systems out there that will do the liability accounting, but I would say that they're probably, you know, not as many as we all would like, but Easy does do a great job with this.
Okay, great. Thank you very much. I have a question, which is actually aligns with a final polling question that I might have. Kathy, can you speak to what you're seeing as far as repricing or modification? Okay, great. Thank you very much. Next question is kind of a long question, so bear with me. It might be a little bit technical. Carolyn or Kathy, please feel free to jump in here. So the question is, how do you handle modifications of awards from ISO to a non-qualified stock option with respect to an expense that has already been recorded? And if kind of the ancillary part of that is, does the expense get classified as an ISO expense to non-qualified expense since the beginning of the award grant?
When you say modification from ISO to NQ, I'm assuming you're talking about the time of the split. The same factors are applied to both the ISO and the NQ as far as a Black-Scholes value and an expense calculation over the vesting period. And depending on how you manage the expense and how your system can allow you to align the two pieces back, you know, it's not, the expense is typically the same on both. The only difference is how it's allocated. Some systems will take, let's say, the ISO and expense it over, and as you know, if you have ISOs and have had experience with ISOs that split to NQs, you can wind up with an ISO that might be vesting in years 3 and 4 of a 4-year vest, and all NQs in 1 and 2. The only difference really in the amount of the expense is how it's allocated. So you want to keep in mind that you may want a system that can say, okay, even though I split it into an ISO and NQ, I want to keep my expense following the model had it been a single grant.
Okay,
Carolyn,
great.
do you think there's anything I missed on that?
You know, I mean, I'm certainly not a tax professional, so I would defer you to talk to your tax department, but I can tell you that I do believe that when you flip from an ISO to non-qual, that it does change the way that you account for it as far as from a tax perspective. So if you definitely have that situation, you should definitely get your tax department in the loop on it.
Yeah, from expense, not so much, but from a tax, good point, it is.
Okay, great. Thank you very much. Next question, I'll direct to you, Kathy, and Carolyn. Feel free to comment as well. Can these systems, cloud-based and on-premise, handle a multi-metric performance unit?
I think you'd have to check with each individual software provider. I don't know. At the time that I was using other systems that were out there that were public systems, performance awards were not as common, and so they didn't have as much functionality. The system I came off of did not have it could handle performance awards, but it had more restrictive. So I would say you really have to look at it from the standpoint that if you're looking at a system because you're going to be doing performance awards, put together that list. The first thing I would ask them, how do they handle multiple metrics? How do they handle the vesting? How do they handle the expense and the DTA? And how do they manage the expense over the vesting period based on what you believe are the chances that this award will or will not vest? So they're all pieces of what you need to consider. Our system does do that, and it does handle those things. So I don't want it to sound like I'm trying to say that it's the answer for everyone. I would just say you need to ask your provider, whoever it is, for a lot of detail around how they manage performance awards and what their functionality will do.
Okay, great. Thank you very much. Next question I'll direct to Kathy. Can you comment to, you went over kind of 3 biggest accounting gotchas. Can you comment on which one is most prevalent and why you think that might be the case?
Let me think about that. I think sometimes it's modifications. I think that often clients don't realize what it's going to cost when the company makes a decision to do a modification. So often when they get down to calculating the new fair value on the reprice, they get kind of a surprise on how that is. So that, I would say that's the biggest of the 3 that we see and that we hear about for the gotchas.
Okay, great. Thank you very much. Next question now direct to Carolyn. One of the things that you mentioned was staying on top of regulations. Could you share with us how you stay on top of those regulations? And I don't know, another specific answer, do you know if any of these applications are helpful in complying with the regulations in any way, kind of built into their applications at all?
I would say absolutely that the systems, you know, they are usually pretty good. I know that Easy is really good about working with the accounting firms when anything changes to make sure that their functionality is in compliance. So I would say that the systems definitely, I mean, there's no system that thinks for you 100%, but I would say that they really do help you maintain and stay in compliance with most of what you need to stay in compliance with. You know, they help you keep track of your forfeitures. They, you know, help you recognize the expense properly on your financial statements. There's a lot of the big firms, they have great books that help you with the accounting and the regulations. I know, I think KPMG has a great 123R book that I think is like been the best Bible. Like, it's just great. And so there's things like that that help. I think that, you know, the accounting firms help you stay on top of those sort of things.
Okay, great. Thank you very much. Kathy, I'll go ahead and direct this one your way. We mentioned one of the keys was to get accounting involved in the design phase. Can you speak to how maybe some of your clients have been successful in kind of inserting themselves into that process successfully at all?
Well, I think that some of our experience has been, you know, that we have a lot of some software and some companies, the person who looks at the data, at least in my old history going way back, was typically the administrator, and if you didn't understand how to distribute the information, it didn't get where it needed to go. More and more software, and I know ours does this too, allows for roles that access for different sections of the organization so that they can go in and look at the data they need without any seeing things they shouldn't be seeing. So in other words, you can control who sees what and who has access to what. I think a lot of that, you have to go after it. I mean, I spent many years when I was in-house building mentors and saying, sitting down with someone and saying, okay, if you're going to ask me for the information, then you need to help me understand. That was before they came out with the CEP. So back then, we didn't have any places to go or how. But I really believe that a lot of the people that I work with from a support standpoint now are more and more often the accounting. When I get a new client who asks questions and says, well, our accounting says this doesn't work, I say, can you please put them in touch with us? Let us talk to them directly. Help them understand how they can use the functionality in the system that you are using to get the information they need. So I think you have to start from the inside and start building that relationship with your accounting department and saying, or with your administrative department if you're in the accounting department, to help them understand how important it is that you get what you need in a timely manner or have access to be able to get that information yourself.
I think that, and I'm sure that this is a huge debate as to who should own your equity system. Should it be accounting or should it be HR? And I can tell you, in our company, accounting owns it. With 123R, equity has gotten too complicated, and accounting really, I feel, needs to own it because it impacts your financial statements too much not to. And it's not saying that, they can't have access and you can't provide them information to know what they should grant people and how much it's valued and what it's worth to the employee. Yes, they can have all that, but really accounting needs to own it because when something is wrong, it's going to screw you up on the financial side.
And the other thing you could consider is if you don't want to change your administrative function. You have an administrative function that works, whether it be a third party, whether it be your in-house team. When I was in-house, it was HR. So it depends on where it is in your organization. But there are tools out there that will help you do the financial reporting side of it without changing your administrative function. You could keep your administrative the way it is and look at systems that will just do the financial reporting side based on taking the data from your administrative system and feeding it into another system to do your financial reporting. So it's another alternative to consider.
Yeah, I think one nice thing that I really appreciate with Easy, and it's, you don't necessarily want your accountants to know what equity options that people are getting, but yet they need the data. And Easy has a great accounting anonymous role, which works really well because it allows me to give my accounting staff access to it to post, the 123R, the compensation expense, without allowing them to see any of the specifics of the employee awards. So that's a great thing to look for when you're looking for a system, is if they allow you to do that.
Okay, great. Thank you very much. Winding down the Q&A session, I'll go ahead and direct my last question to Carolyn. So if someone in the audience is on Excel and they're looking to make that move to the automation front, whether it be on-premise or a cloud-based solution, can you give us your advice on maybe the three key considerations that should be made on their end in deciding what's the best way to upgrade that system for their company?
Yes. Yeah, as far as I would say that I think it's pretty, if you're going from Excel to a system, it's pretty easy. And I would say that, you would have to go in there and you would have to set up your plans and you would have to do all the setup in the system, but an implementation would be fairly painless, I would think. I mean, what do you think, Kathy?
Yeah, I think so. I think the three main things, this just came in my head as I was listening to this. You're right. But there's three things you need to consider. Number one, remember that no matter what choice you make, you need to have resources up front to get you through the implementation. Whoever you decide to go with, you still need to have control over your data. So you need to be sure that you have that. The next is that the system be flexible and secure. To me, they're the three things. That it gives you the flexibility you need to be able to manage your process, yet keep the data integrity, and make your life easier.
Okay, great. Thank you very much. With that, we're going to go ahead and conclude the Q&A session. A big thank you to Kathy and Carolyn for their time and insights. They're clearly thought leaders in their field and excellent source of information on today's topic. Note that in the post-webinar survey, be prompted to take right after the webinar concludes. You have the opportunity to express your interest in being connected with today's speakers with just a few mouse clicks. Again, big thank you to today's sponsor, Equity Administration Solutions, for their support. Finally, a big thank you to the audience for your valuable time. We hope to see you again soon at another Performative event or online at www.performative.com. Make the rest of your day great, everybody. Thank you very much.
The organizer has ended the session.